Let's break down this Doordash play. And if you're looking at the screenshot, so we took a 7% loss on this play. And I probably should not have bought this. And we're going to kind of show you using some of the charting that I probably shouldn't have bought it. But I'm going to kind of give you my justification for why I was bearish on this particular company. Been for a very long time and still am in the current, in the present. And, you know, we're going to kind of talk about some of the macroeconomic situations around Doordash. And what I want to try to get you to understand is one of the things that I'm better at than I would say 99% of the people that are in this trading space is I'm really good at using fundamental analysis to kind of understand the direction of a share price. And I use fundamental analysis and I also tied it into what the overall macroeconomic situation is. And the people that have taken what I've taught them and they have applied it have been very, very successful in the markets. And because this is not a technical analysis skill, even though I do use technical analysis and we're going to go into that. But I'm really good at looking at a company and looking at its financials, understanding the market that it actually exists in, which is really the most important thing, understanding their business model, and also understanding how macroeconomic forces are going to impact that to create a really good analysis on what direction I think the share price is going to go, especially over time. And that's what we're going to talk about in this particular video. So I took a 7% loss. I talked about before, I probably should not have bought this contract, and I want to kind of show you why. So the contract was bought on February 16th, exited on February 22nd of 2022. Let me show you. So February 16th, let's go to the VIX. Let's go to the 16th of February. The VIX was around 24. Not that bad, right? And I got out on the 22nd. The VIX, however, was above 20. And one of the things I always teach my traders is that when the VIX starts to become elevated, you got to be careful because a lot of times you bind a contract at a high IV. And if you don't get the continuation that you're looking to get, you can get an IV crush just from the VIX getting softer. Or you buying at a really high IV and then the IV doesn't continue to appreciate, which is what you want to increase your premiums. It can kind of trade flat. And then as a result, you don't get the move that you want, right, in your premium. So even though the share price may move a little bit, because you bought at such a high IV, let's say you buy at 100% IV, and then over the next 4 to 5 days, the IV, the share price doesn't move the way in which you want it to do. Let's say the IV goes up maybe to 110, right? You don't really get that move in premium that you may want to get based on the amount of risk that you took, because this was a contract in which I put up, it's 2 contracts. So I'll put up around $2,000, right? And so you would, for that level of risk, you would want to make sure that you're getting a certain amount of return in regards or in accordance to the amount of risk that you're taking. And that risk is going to be person to person, situation by situation. However, I want you to always understand risk management, but I do try to make sure people understand is that, you know, elevated VIX when you're buying the contracts can really impact your premiums, because what you want to do is buy a contract with a low IV and sell a contract back to the market with an elevated IV. And what you want, best case scenario, is a perceived risk of higher IV during the time of high volatility. So what do I mean by that? And I'm gonna go ahead and get into it. I don't want to turn this into like a full discussion about this. You want people to buy a contract back from you, right, when they perceive the IV to continue to go up for whatever reason in a situation of already high IV. So you want, and if you're looking at a call contract, right, you want somebody to buy from you in a situation that's good, that they think is going to get better. When you're selling a put contract, you want somebody to buy the contract back from you in a situation that's bad, that they think is going to get worse, because a put contract is an insurance policy, right? Call contract is also an insurance policy, but it's an insurance policy based on the optimism of the scenario. And that's how you want to kind of look at this. So let's go into the dash. So we bought on the 16th, got on the 22nd. And let me kind of show you on the daily chart what I'm talking about. So February 16th, if you can see that, let me zoom this in a little bit. Okay. Got it on the 16th, right? Closed at $94. It's a $95 put. This is what kind of made me become discouraged on the play. Next day it opened up at 115, closed at 105. Then the next few days, I'm not seeing really the big strong move that I wanted. You remember I got a $95 put. So I lose some of my premium here on this push up, right? Because I was pretty much in the money when I bought it. Lose some of my premium here as it moves up. And then I'm never able to get to really massive or rapid movement back down that I was looking for. So I say, you know what? This capital can be utilized in a better place, on an easier play. And one thing I really made a commitment to in 2022 is take easy plays. So I just sold the play. And what I probably should have done, and I'm gonna kind of show you this, was got in earlier, but I had so much capital in the markets in November, I wasn't able to participate in this particular play at that time, because we see the biggest amount of sell-off was between November and pretty much first of the year, because it went from 250 all the way down to like 150. Then we got like a 150 move all the way down to almost 100. So month to month, we're getting like $100 moves. So what we're probably going to see is a little bit of consolidation as it tries to figure out what direction it wants to take next, right? And as people start to readjust to this new price. Now, why am I so bearish on Dash? First thing, their business model. Delivery models are not good business models. You don't really make money on delivery. Delivery historically has been food delivery historically has been like a service or I don't know what the proper word is. It starts with a C, that businesses will provide to their customers if they bought over a certain amount. So when I was coming up, you went to like a place, they would do delivery if you bought like over $50 worth of food. And they also would do it in a very limited area because they didn't make any money on delivery, right? Now we have this delivery model, which makes sense because it's a convenience that people want. The problem is the way in which this business is constructed. Delivery doesn't really make sense. Do I think it makes sense with like ghost kitchens? Yes, it probably will make sense with a ghost kitchen, because a ghost kitchen is very similar to a mom and pop stop that says, okay, we'll do delivery if you buy over a certain amount from us. Therefore, it makes more sense. The way this is constructed, the way this business is constructed, is that it doesn't really make sense for them to have this business, because one of the issues that Doordash is going to have, and we're going to show this, is that they're not more efficient as they scale the business up. So what you want to look for in a lot of businesses, and all my engineering people may understand this, so like Kay Alexander may have a better explanation than me because she comes from an engineering background, is that when you're engineering a product, as we produce more products, we want to become more efficient at producing that product, which means that the cost of producing the product starts to go down, right? And then we're able to capture those savings and put that into another part of the business. If we're applying a service, we want to try to figure out, as we deliver more of that service, the cost of delivering the service starts to go down, and we're able to capture those savings and put that into another part of the business. What we're seeing with DoorDash is as they deliver to more people, the costs don't go down. In fact, they go up, and that's an issue. And you can kind of look at that if you look at their statement. So we see that the profit margin is negative by around 10%, operating margin is negative around 9%, return on assets negative by 5%, return on equity is negative by around 10%. And a lot of people will say, well, they're in the growth stage. So, they're going to have to spend a lot of money to become profitable. My question I want to ask is, what is the path to profitability? Like, explain a scenario in the marketplace that allows this company to become profitable. I'm going to repeat myself. Explain a scenario in the marketplace that allows this company to operate profitably. Let's say everything. So let me give you an example. Tom Brady's coming back to the Bucs, right? Okay, so here's a scenario in which the Bucs win the Super Bowl. Tom Brady stays healthy all throughout the year. All the skilled players of the Bucs stay healthy, because that was the issue they had last year, where the players started to get hurt as the year went on. All the skilled players for the Bucs stay healthy throughout the whole year, and the Bucs secondary actually shows up this year. That's a scenario in which the Bucs win the Super Bowl, the 2022-2023 season. Okay, so that's what I mean by create a scenario in which it works. So give me your best case scenario. What has to happen in the marketplace for DoorDash to become a profitable company? And then what time period do you think it takes for that to happen? Now, this is what you got to understand from a macroeconomic standpoint. Federal Reserve say he's going to raise the interest rate by 0.25, and they're going to do subsequent raises over the course of the year. So what's going to happen now is the cost of capital is going to go up. Now, that's very important for a company like this that's in a growth stage. Also, the rate of inflation is going to start to go up, which means what? If they're going to be profitable in the future, the value of those profits is going to be less because of the rate of inflation. So I'm going to explain myself again. If they're going to be profitable in the future, let's say we can create a scenario in the marketplace where this company becomes profitable 2025. What do we project the rate of inflation to be in 2025? Therefore, those profits will be less valuable in 2025 than they currently are today. I'm an investor looking to get a return on my money. Is it worth me to invest in this company today and they won't be profitable until 2025, and the value of those profits in 2025 will be less valuable than they are today? We're not even going to go into it being a risk-off situation. We just going to deal with the rate of inflation on the profitability of this company and how we're going to perceive that because of the rate of inflation. Therefore, I'm an investor looking to get a return on my capital. Does it make sense to me to invest in this company? Well, not only they're not profitable, the return on equity is negative. So the capital that they're using, they're not very efficient with use of the capital. So that also means that management doesn't really understand how to use the money that I'm investing in the company in a good way to get a positive return on equity. Like I said, they're in a growth stage. But when they ever figure this out because of inflation, the value of them will be less from a profitability standpoint because of the rate of inflation. And that's why I tell people, anytime somebody's projecting the value of your dollars in 20, 30, 40 years, they always need to factor in the rate of inflation. And if they're not doing that, in my opinion, you're with the wrong people. I don't care what school they went to, because a person is a byproduct of their training, but it doesn't mean that their training is sufficient. What do I mean by that? I used to have massive tendonitis from playing ball, to the point that where I would play ball and my knees were hurt for like a week, right? It had nothing to do with age. It had everything to do with just wear and tear, especially growing up where I'm from. We spent a lot of time playing ball on concrete. So over time, I just started having big tendonitis issues. I played ball, my knees were hurt for a week. Went to a lot of doctors. You know what they told me? Just take anti-inflammatories. Why did they tell me that? Because that's their training. So based on their training, that's the correct answer. However, the trade-off of taking anti-inflammatories is they can cause peptic ulcers, they can cause strokes, they can cause heart issues. I went to college with a girl who was a pitcher for our softball team. You know, to try to protect her arms, she was taking a lot of anti-inflammatories. She was 24 years old. She had a stroke. You understand me? But based on their training, that's the right answer. So these doctors have been trained, they've been certified, yada, yada, yada. Based on their training, that's the right answer. I had a guy tell me you could take ibuprofen every day as long as you take it with a full meal. Told me that a long time ago. I can only imagine where I would be there if I took that advice. If I said, okay, you know what, that makes sense. Let me take an ibuprofen every day as long as I take it with a full meal. Now, I'm not saying that in certain situations people don't have to do this. What I'm saying is that the trade-off of doing it is what? These particular things. But based on their training, that is the right answer. So I want you to always understand, I'm not against people being trained. I'm not against people being certified. However, they are a byproduct of their training. And many times they have a myopic point of view because of how they've been trained. And when you're looking at projecting something into the future from a financial standpoint, if they don't take into account the rate of inflation on those future profits or the future profitability or the future equity in that particular company, in my opinion, they really are not really aware of the reality of the situation, because as an investor, I want my investment to exceed the rate of inflation over time, not be defeated by the rate of inflation. And that's an issue with this particular type of business. And I'm gonna kind of show you what I mean. This Doordash balance sheet. And one of the things I really encourage people to do is like listen to earnings calls, look at their balance sheet. Now, what I want you to see is that December 31st, 2021, there's a decrease in cash and cash equivalents. And what we're seeing is that Doordash is kind of burning through their cash on a year-to-year basis, right? Another thing I want you to look at is accumulated deficit. And we're seeing that accumulated deficit is increasing for Doordash. And when I want to look at a definition of accumulated deficit is a negative retained earnings balance. This deficit arises when cumulative amount of losses experienced and dividends paid by a business exceeds the cumulative amounts of its profits. An accumulated deficit signals that the entity is not financially stable since it requires additional funding. However, this may not be the case for startup businesses where substantial initial losses are expected before sales begin to take off. Okay. Then they give an example where an organization generates $100,000 of profits, pays out $25,000 in dividends, and then experiences $150,000 of losses. Its accumulated deficit is calculated as $100,000 profit minus $25,000 dividends minus $150,000 of losses equals $75,000 accumulated deficit. And Doordash is a startup. I believe most businesses are startup until they hit the 10-year mark. But we want to talk about, is an investor prepared to deal with losses in a higher cost of capital environment, a higher interest rate environment, and a higher inflation environment? Does Doordash now become a great place to put your money to get an acceptable rate of return? Right? And is it still in a growth stage? That's another thing. And that's what I want people to really understand, is that we're in a risk-off scenario. And let me go back to the chart. We were in a growth scenario the past year, 2 years. We're now in a risk-off scenario that pretty much started late in the year. Right? Everybody thought it was tax harvesting, but really we were in a risk-off scenario. And what we're seeing is that a lot of these companies, to where it made sense when the cost of capital was very, very low. It made sense when we believed inflation to be very, very low, to invest in them, because we understood that, well, they're not going to be profitable into the future. And we didn't necessarily have information that future inflation is going to be very, very skewed towards the high side. And they were still in a growth stage. However, what the market pretty much believes is all the growth pretty much has been gone out of this company. Okay. A lot of the growth was here on this move up towards 250. And then it's pretty much on the way out. And that's kind of how the market is perceiving this. And it has a lot to do with the business model, things of that nature. Now, you may get some consolidation. You may get some consolidation in the 80s. However, I believe over time, and this is not investment advice, that their EPS will continue to become, the EPS loss, will continue to become greater and greater. Because one of the things, if you look at this particular balance sheet, and I want to show you, where is it at? Okay. Sales and marketing is going to go up. Why? Because marketing always goes up. Right? You rarely are in a scenario where you can spend less on marketing year to year. You normally got to spend more because most marketing platforms, if they're valuable, become more expensive over time. They're spending a lot on R&D that may continue to go up. The other thing I wanted to show you was that they are diluting their shareholder. So what we're seeing is that net loss per share year to year went down, but numbers of shares went way up, ×5 almost. Therefore, what they're doing is they're diluting their shareholder. Therefore, again, why would you be in this deal if they're not going to be profitable anytime soon, and then your equity position is being diluted over time by the company? And that's what you really want to understand. And that's why I really encourage people to really kind of realize what you're getting into, because with a thing like Doordash, which is an app, they know that you've been kind of programmed to look at something a certain way. So they jump on the television, and they get placement on these quote unquote financial shows with people that are quote unquote certified to talk about finances. And they say tech 300 times. But at the end of the day, you got to run a business in the market. And you got to try to figure out what about this particular model makes this business work or will not make this business work. You create a best case scenario, you create a bad scenario. Now, is it a place to maybe get some growth out of. Yes, but then you got to know when to exit the market. And a lot of people don't realize, when to exit the market, right? And you got to have your own, kind of projection when you come into this deal. Because we're now under the IPO price, right? We're under the IPO price. And therefore, we want to kind of see how far this falls. I have this maybe around $50 around summertime, but I could be wrong. They could come out earnings and everybody's using Doordash. I'm just not a big fan of a delivery business as a standalone business, as a pure play. Not a big fan of it, right? Just because of the actual metrics of the business. Because my question always is that how does a business become less expensive as we scale it out? Because DoorDash only works if it's everywhere. How does a business become less expensive as we scale it? What you a lot of times see with businesses like this, they become more expensive as you scale it, and they're very sensitive to macroeconomic situations like the rise in gas. So if we're already operating at a loss and then gas goes up, which makes it more expensive for us to run the business, now what happens? You understand me? And that's what I want people to understand. We're already operating at a loss, and then we get regulation that states that our freelancers now have to become employees. And then once they become employees, we got to do what now? Now we got to pay them federal minimum wage. Becomes a totally different business model now. Because our margins are already under a lot of strain because it's a really weak model. Right? And that's what I want people to really understand. And you can kind of understand it if you get on these earnings calls, you start looking through these balance sheets, you start looking at what these words mean. You don't have to be an accountant by trade to understand how to read these balance sheets. I'm on spaces to where people have really, really good, robust conversations around the financials of a company. And I'm here to tell you, none of those people in these conversations are accountants, but they do know how to get money out of this market. That's the difference. An accountant is trained to be an accountant. We're trained to trade. It's a difference. Everybody got a different function. And that's what I want you to understand. So this probably was a bad trade based on my timing. However, I am still bearish on this particular company long term. It's not financial advice. It's just my own opinion of the company. And if you got any questions, hit me up in the comments. Let's look at this Wayfair play. And Wayfair is like a online home furnishings space. They're like an e-commerce play in the home furnishings space, if I said that properly. And, we got a 30% return on this particular play. It was almost like a monthly. And I got out because I felt like the play was starting to flatten out. Wanted to get out earlier, and I didn't get the movement. Now, this was a continuation play. So what I did was that I played Wayfair earlier this year, was able to pull some good profit out of it. And then I felt like it was going to continue to decline. And I still feel like it's going to continue to decline, even though that's not investment advice. And looking at their chart, what we're seeing, let me go to the 2-year. We're seeing a big move up, and we kind of know why this took place. So why did this take place? Because we're in the pandemic and everybody's now ordering online. So what we see is a stock that historically performed, right? Let's say in this range, between maybe $90 and $100, gets sold off because of the pandemic, and then it gets a big move up because everybody's inside ordering. It trades in that particular range for a certain amount of time, and then we see it starting to break down. And this is around November where everything started to break down because we saw it reject 350 twice. Rejected 350 here in 2020, rejected 350 here again. It rejected 350 here on 1/11/2021. We saw that the high was 369. It rejected that real long candle, rejected 350 here. So it never wanted to really trade around that 350 mark. Nobody felt comfortable at that price, and even then it was overpriced. And then we see from here, it just started to move down. And one of the reasons it started to move down is because its earnings became less and less credible in relation to that particular share price. And it was a growth play because of the pandemic. And then once everybody realized that people are going to go back to their normal behavior, which is what? Buying furnishings from in store, and you may buy some stuff online, but the majority of stuff you're going to buy in store because you want to try it out. You want to kind of have a perception of how you think it's going to look in your house, and it can be hard to do that on the internet. We started to see it start to lose a lot of share value. And one of the reasons is because its revenue started to go down because people just started to use it a lot less. And that's just reality of the scenario. Looking at their statistics, profit margin is really not that bad. It's not great, but it's not that bad. E-commerce space a lot of times can be difficult to be really profitable in. You may have a lot of orders. You may also drive a lot of revenue, but the profit can be kind of hard to capture. But one thing I want you to understand is the quarterly revenue growth year over year is negative. And that's what I want you to really understand. And we're going to kind of go a little bit deeper into that. If you look at their earnings, so we say when they started to miss revenue, right? It was starting around June 2021 reporting. So quarter 2 2021, we see it negative 73, negative 122, and then negative 24. Right. And then we're seeing that we're starting to become negative year over year comparables. And what you want to do normally is exceed your year to year comparables. What we're seeing is that from a quarterly standpoint, we're starting to become negative year to year. And the problem that we have, and we see this in the chart, is that people just started having a really bullish perception of this because of the pandemic. We started to trade in this particular channel, and nobody could really find a reason to bring this back up. Now, how far down do we think it goes? Do we think it goes under the pandemic price of around $27? It may not. But the issue is that this company at one time was trading under 50. If the trend just totally starts to go away from buying furnitures on the internet, what's their value proposition? Okay. And then it comes to how well is management operating this particular company? And that's what you got to understand. There was a note that came out. This was in November. This is really what caught my attention. Is that revenue's falling. And they talked about that. We believe Wayfair's share price depends on revenue growth, and revenue has not fallen for 2 straight quarters. And this is when they were trading at around 254. So now where they're trading at, it may be a decent price for them. I really think still they're going to probably trade around somewhere under $100. And this company, I haven't really looked at some of the threats that are on this particular operation. However, what we're seeing and what we saw, and this is another thing, they sold off in like that November area. Here we go, around here, started selling off, and then just a real big decline. Also another risk off scenario. Let's try to get all the risk associated with this particular company off the table. And that's what I want people to really understand, is that when you're combining a risk off scenario with a company that is declining in growth, it can put you in a position to be very profitable. And this is kind of how I try to look at things. I'm not still good at, what's the RSI with the MACD that's going to give me the perfect entry point. I don't really look at it that way. And so it doesn't mean that that's the wrong way to look at it. It's just that everybody looks at this market differently. The goal is to kind of figure out how you can put yourself in a position to be profitable based on how you perceive the market. But I think a lot of people don't really understand the actual scenario, and they may be thinking that this technical situation is going to be the clue. And I would encourage you to really kind of understand, unless you're going to be purely technical and make that your thing, just kind of understand what's going on in the market, what's going on with that particular company, and what are some of the factors that can impact this, or either drive it up or drive it down. Okay, so that's going to be the Wayfair play. Okay, let's look at this Carvana play. We did around 476%. We can call it 480 on a roundup on this particular play. And I had been talking about this a lot on my community page, and kind of tip people's hat to what was going on over there. And looking back now, you can always look back in retrospect and what they call it Monday morning quarterback it. If I would have put around 4 grand, 4,500 into this play. I kind of probably could have pulled out around $24,000. Had a lot of conviction on this play because of what I kind of believe is going on over there. And if I was to really break it all the way down, I'd be on YouTube talking for like 4 hours straight. It's interesting that like a forensic accountant or a CPA doesn't see this, because if I can see it, it should be way obvious to somebody else that's trained in this particular space. We're looking at a company that's probably had 1 quarter of profitability since maybe 2017, 1 quarter, right? So over 190-day period since 2017 of profitability. One of the biggest issues with Carvana is it's a very expensive business to operate, right? The way in which they run this business is very expensive. A lot of people will tell you they overpay for their cars. In looking at the used car space, it's a very fragmented space. There's used car dealerships all over the country. Nobody really has a really strong footprint over any area, and nobody has really been able to really consolidate. Even though I know people know about CarMax. CarMax really doesn't dominate the used car space, even though I know they're everywhere. At least where I'm from, they're everywhere. It's a very fragmented space. And so Carvana has sold people on the idea that we can consolidate this space and we can essentially take up a lot of market share. A lot of people would tell you that they overpay for cars, and they overpay for cars just to capture inventory, and then they have issues selling that car for profit, and which is one of the issues why they have a profit. So the type of business where they're driving a lot of revenue, but it's not a lot of profit. When you look at their balance sheet, negative profit margin, negative operating margin, negative return on assets, negative return on equity by around almost 50%. One of the things I want you to understand is that they're negative operating cash flow and lever free cash flow. There's like a lot of stuff going on and a lot of games being played with this particular company. The way in which they account, a lot of it is weird. It's very sophisticated. It's being done by some really smart people. But it just doesn't make a lot of sense. But they're getting away with it. So I guess it does make sense. If you look at their share price, they're another company that kind of blew up because of the pandemic. So we see that, pre-pandemic, they were trading at around under $100, right around 100. They sold off because of the pandemic and they just shot out of a cannon. And they one time got to around almost 370. And then we just see a lot of de-risking going on. So around summertime of 2021, they started to sell off. You had a little bit of a consolidation here, started declining, and then they declined here really hard. People came in and bought that dip, and then they started to sell off really hard like everything else around the top of the year. If you look at their earnings, right, really bad misses, I wouldn't say bad misses, but misses here on revenue. We're seeing another earnings per share miss here. But like I said, their accounting is kind of weird. So they make it look good on paper. But if you actually look at it and you look at how they account, it really doesn't make a lot of sense, at least to me. Like I said, I wish like a forensic accountant would really come in there and start tearing this thing apart. But they don't have an incentive to do that because that's how the system works. So earnings per share missed 2021 September reporting. December 2021 earnings per share missed. We're starting to see the year over year start to go down, but it's similar to where it was here in March 2021. What we're looking for next quarter is that year over year to go down more. And then we can kind of see that, we're starting to see a decline in revenue being driven into the particular company. And that's kind of what we want to maybe look for, because based on inflation and based on the cost of capital, people may stop buying cars, right? Even used cars. And if Carvana is overpaying for the car and then people stop buying cars, well, first they got to figure out what to do with that inventory they got, because it's an inventory business. Then we got to figure out how to drive new sales, and that can put them in a really, really bad spot. So what I would do, and this is not investment advice, I would reach out to my people that are in the used car space and ask them, can I get an honest understanding from them about how business is going? Because if cost of capital goes up because of inflation, things of that nature, and people just stop buying cars, and Carvana now has to deal with the fact that, one, we got to move this inventory before a certain date, and we overpay for the car to acquire it, So our margins are really, really thin because we kind of paid over what the market would normally pay for this vehicle just to have vehicles in inventory. Then the cost of putting the vehicle in the PEZ dispenser and, operating that particular system and yada, yada, yada is very expensive to us. It creates a lot of overhead. As revenues start to become more and more challenged, this thing can look a lot less attractive, even at this 124 print we currently have going on right now today. Right. So my projection for Carvana, and this is not investment advice, is it's starting to move under $100. And that's going to be a big move because we can look at just summertime of 2021. It was trading at 358. I believe by summertime of 2021, it'll be under $100. So we're looking at a massive move within a 365-day period. And we're not talking about we're not even gonna go into the issues of the fact that like people not getting their titles, just a lot of issues. Selling used car businesses, it's a big paperwork game, and you got to really be on top of it. And Carvana has kind of been, I wouldn't say prohibited, but they've had issues in certain states operating because the paperwork's not necessarily up to speed. You got to be careful because you don't know whether or not these people giving you a car that might have been flooded. The car might be hot. You never know. I definitely don't think another group of people could run their business the way they're running it. I don't think they would be allowed to, but they're being allowed to run this business the way they're running it. And I think that this can down the line have severe implications for this company, or they might get away with it. Like I said, if you look at their balance sheet, look at the way they do accounting, there's a lot of really sophisticated stuff going on, but it's working. So their attitude is we just going to keep doing it because the insiders of this company, they have a way of cashing out on this deal. And I don't think people really realize that if they're not paying attention. And so that's going to be the Carvana play. So that'll probably be the biggest individual play for me because it's just a one contract play. Probably the biggest individual return. And I want to tell people, you may not always get these kind of returns. So I wouldn't press it to try to get it because I really thought this could be 1,000% play, but it just didn't go that way. It's sometimes better to get the consistency than just the one big play. And a lot of times we look for the one big play as opposed to the consistency. Both are going to be there, but money comes in seasons. And therefore, when you understand that money can come in seasons, you can have a scenario where you're hitting for really, really big amounts. But I wouldn't want to encourage people in the way I do it. So I'm gonna speak about myself personally. I try to make sure there's a consistency in what I'm doing, so I'm not always trying to press for the big play. Because a lot of times what happens in this market is people press for big plays, even though they're there, as opposed to letting it come to them. They're pressing for the big play because they want to kind of justify their position in the market by the big plays. And I had to learn that the hard way because after the first pandemic, we was hitting everything for 400, 500, 600%. And then once that was over, I had to go back to really being meticulous and being very consistent with what I was doing because those type of scenarios were not just always there. And that's what I want people to understand. So this was an example of kind of like an over the top move, but that won't always be there. Right. So I want to encourage people to really look at their consistency because, if you're playing defensive back, the big play is not going to always be there. So you got to play your technique and you play your technique. So when the big play's there, you can attack it. But if you just always try to turn everything into a big play, you're going to get burnt a lot. And you're going to get burnt so bad, you're probably going to end up not playing. And that's what I want people to understand. So that's the Carvana. If you saw the earlier videos, you saw the Wayfair. If you saw the earlier videos, you saw the Doordash. If you got any questions, hit me up in the comments. But I want to really encourage you to be encouraged that you can be successful in these markets. And stop letting people tell you that you can't because they're trying to protect their position or because they don't have that belief in themselves. So then therefore they can't see that for you. You understand me? And one of the things in which I want people to understand is that most people that I maybe have known, let's say 5 years ago, couldn't see me. And I'm not talking about my immediate family. I'm talking about like people I knew socially. They couldn't see this for me. They just didn't have the ability to perceive that for me. And many times in life, we're letting people that, one, really don't know you. Two, they're limited by their own point of view. They put a short horizon or a short ceiling on you, and then they try to program you that that's going to be your capability. I'm not saying that people don't make mistakes. I'm not saying that you should, be arrogant or be foolhardy in how you move. What I'm saying is that really watch how you let people program you about your ability to be successful in certain spaces, because they can't perceive themselves. Then therefore that means they can't perceive you as having that ability. One of the things I learned is that everybody can't do the same thing, right? Some people can play professional sports, but everybody can't. But that doesn't mean that you might not be able to. Everybody can't be a professional musician, but that doesn't mean that somebody can't be it. Everybody can't be a scientist, right? But that doesn't mean that another person can't be one. Everybody's not going to be able to go into space. The majority of the planet will never go into space. But you know what? Somebody's going into space. Most people will never be jet pilots in the military. But you know what? Somebody's going to be a jet pilot. Most people will never fly a helicopter for the military. But you know what? Somebody's going to fly that helicopter. Most people will never work on a sub. But you know what? Somebody's going to work on the sub. You understand me? You have to stop letting people program you that you can't do something because that's not their ability. And that's going to be the most important thing in the world that's going to probably allow you to have your success. It doesn't mean that you should just do whatever you want to do and just tell people they got to deal with it. But I just want you to understand is that many positions in the world that are specialized, they're specialized because the majority of the people in the world can't do it. It doesn't mean you can't do it. You understand me? There's going to be 30-something guys that are going to start in the NFL at quarterback, right? Everybody else can't start in the NFL at quarterback, but somebody's going to take that position. And so you really got to ask yourself, what position am I accepting for myself in this world? What position? And when you start to ask yourself that question, then you ask yourself, well, who told me I was appropriate for this position? Why do I think this is the position for me? And how come I don't think I can do this over here? And that's what I want you to really start looking at. And then you'll start to realize that there may be more opportunity, or there may be different opportunities in the world than you ever imagined, because you start having a different point of view about your position in this situation. So that's going to be the wrap up. David W. Williams, also known as Diamond Dave. I'll talk to you later.